that was, I wish I could blame that error on someone else, but that was self-imposed. So everybody, I think you heard my earlier stuff. Kevin's here to help me out. Let me just remind you that the information today is for general purposes only. And also remember that fixed income securities are subject to increased loss of principal during periods of rising interest rates. Fixed income investments are subject to various other risks, including credit quality, market valuations, liquidity prepayments, early redemption, corporate events, tax ramifications, and other factors, and the risks associated with dividend-paying stocks. There are risks included there, and they're including but not limited to the risk that the stocks may reduce or stop paying dividends. Okay, everybody. So thank you. Let's head on over to the Schwab.com website, folks. And let me just pull that up real quick. Here's Schwab.com. You guys are familiar with this. And before I go too far into this, I want to show you one great resource for you in terms of learning fixed income investing and bonds is this website. Okay, let me go to Learn at the top of the page. I'm going to go to Courses right here, and we have some different courses. One of these I'm going to show you in just a little bit is one called Income Investing, which cover bonds. Okay, let's do this. Let me show you something else though here for a second. I'm going to click on this Simple Steps to a Retirement for a Retirement Portfolio course. I'm going to open that up and I want to show you something. Here's asset allocation and diversification. Because what I think sometimes happens, and I'm just going to scroll down on this page. I think what sometimes happens is because of the content that we teach a lot of trader content here, which is great. That's what we do. That's where there's a lot of focus. But I don't want to give you the impression that the entirety of your portfolio needs to be shorter term trading strategies. Okay, that may be a part of your portfolio, but bonds, when you start looking like one of these pie charts, these asset allocation charts, and you look at the allocations, it's very well likely bonds are going to be a part of that portfolio. So I want to talk to you about bonds today, where they fit in the mix. Okay, where they fit in the mix in your portfolio. Now, why do people invest in bonds? Let me just mention this, okay? If you have a 100% stock portfolio, and this is just historical data, okay? I'm just pulling this from the site, historical data. It gives you a certain average return. Obviously, that average return changes, and we don't know what it's going to be in the future. But something that comes along with the return is the risk and the deviations in that portfolio. In other words, you have good years, you have bad years. If you have a 100% stock portfolio, your returns may or may not be better than if you have a mix with bonds in there. But what traditionally has happened is your annual, you have more volatility in there. By adding bonds in, it can potentially reduce the ups and downs on your portfolio, possibly with not a super significant, and again, I don't know what the future returns are going to be, possibly with not a super significant hit to your returns there. Okay, so just be aware of that, folks. That's why people use bonds. That's one reason people use bonds. So I encourage you to go through this portion this is the Simple Steps for a Retirement Portfolio course. It talks about diversification, talks about different asset classes, cash, stocks, bonds, commodities, things like that. Check that out, please. I think it will be, I think that will be helpful to you if you do that. Now, what are bonds? Bonds are a loan. You loan an entity. When I say an entity, what I mean is this. You loan a company, you loan a government money. You buy the bond, you give them your money, and in return for that, they pay you, okay? They pay you. So what's the risk of that? Well, think about it. You loan some money to a buddy. There's some risks to that. The risk is your buddy never pays you back, all right? Maybe he's not such a good buddy, or I don't know. The same thing is true with the company. You loan some money to a company or you buy a bond from a company, there's a risk that that company goes out of business and you never get paid back. That's one of the risks there. Same thing with the government. Theoretically, governments can default. Now, generally, if you buy a treasury bond, it's considered to be super low risk because the U.S. government traditionally hasn't defaulted, but there's no absolute guarantee on that. All right. The nice thing is government has a printing press they can use, right? Corporations don't, and so that's why different companies are rated with different credit ratings there. There's other risks though, other than just risk of non-repayment, okay? Risk of a default risk, okay? There's other risks to that. There's risk that interest rates change. Maybe you are, well, let's say you buy a bond and there's a 3% rate now, and then rates go way up. Well, look, you're going, look, I'm stuck. I bought this bond, and you're not necessarily stuck. You can sell it back, but it doesn't mean that you can sell it back for what you bought it for. The price of the bond can change there too. So please be aware of that as you do it. There's different risks that are present when you buy bonds. Okay. So when we talk about bonds, let me just pull this up. And let me just kind of mention there's two general classifications of bonds. There's what I'm going to call corporate bonds. I'm going to focus on these today. Corporate bonds. Okay, that's for a company. And there's also government bonds. Now, there's different types of government bonds. For the most part today, I'm going to focus on treasuries. Okay. I'm not going to focus on everything, but these are the two broad categories that I'm going to focus on here today. And we can see these on the Schwab.com website. So let's do it. Let's go to the Schwab.com website. I'm going to go up to research. I'm going to go down here to bonds, CDs, and fixed income. I'm going to pull this up, and we're going to pull it up, and I just want to show you. We have a table showing bonds, types of bonds. Now, I mentioned I'm going to be focusing on U.S. Treasuries. I'm going to be talking about corporates. Now, notice different corporates are listed differently here. There's 3 corporates listed, but actually, this is not an exhaustive table. There's different corporate bonds that are even lower graded than these. Okay, AAA is considered to be the least subject to default risk. Okay, AA, still fairly highly rated, but a little bit more subject to default risk. A, still relatively highly rated, but more subject to default risk. Now, sometimes you can get into areas called junk bonds or high yield bonds, which will have a lower rating, maybe a B or C rating. Those are much higher likelihood of default risk on those. And consequently, the interest rate on those is going to go up. So in other words, as you go down the spectrum of the rating spectrum here, as you go down that rating spectrum, then notice the interest rate here. It goes up. The interest rate goes higher because you're taking more risk as you do those, or as you take those bonds. Now, here's a 3-month bond. In general, as you go out more and further in time, we're going out further in time here, the interest rate is going to be higher. Okay. I'll show you how to get here in just one sec again. Okay. In general, though, as you go out farther in time, that you get a higher interest rate. Okay. And now, if you look at these carefully, it's not always the case. It doesn't exactly match that necessarily. We have a relatively flat yield curve right now, is what we'd call that. I'll show you that in just a minute. Okay. Let me just scroll down this page. You can go down here. This is what's called the U.S. Treasury yield curve. So this is talking about U.S. Treasuries. Okay. This is talking about U.S. Treasuries. And so in general, and so what this is a chart of years, months to maturity. I know it's hard to read this. Kind of trust me on this. And this is how long, this is further out till maturity. And this is the interest rate. A traditional yield curve kind of goes up like that. Okay. That's an upward or normal yield curve. An inverted yield curve is one that would kind of go down like that. Okay, that'd be an inverted yield curve, and usually that's a sign of a less than healthy economy. We've had an inverted yield curve for a while. It's now actually slightly positive. You can, it's hard to see. There's a slight slope here up maybe now, okay? But we're pretty flat on that yield curve, meaning you're not rewarded as much for going out further in time right now on that. So that's the yield curve. Now, how did I get to this page? I simply went up to research at the top of the page and clicked on bonds, CDs, and fixed income. All right. And it's possible sometimes when you go to this page, there may be a disclaimer you got to click on before you go there. So that's the yield curve. Now, here's another thing we need to know about bonds, and that is this. When we look at bonds, there's the bond price, how much you pay for the bond, and there's the bond's yield. Okay? There's the bond's yield or the interest rate. Generally, these go opposite directions of one another. If the price of the bond goes up, the yield is going down. If the yield of the bond is going up, the price of the bond is going. If the yield goes up, the price is going to be going down. Price and yield go opposite. We'll see examples of this as we go forward on this. Okay, we're going to look at that more as we go forward on this. Now, I mentioned already, there's that simple stocks. Let me go back to learn. Let me click on courses. There's that simple steps for a retirement portfolio course. All right. Simple, and that's one you can use. But there's also this fixed income course, this income investing course. Now, the whole thing isn't bonds. Like if I click on it, you'll see Introduction to Income Investing, dividend stocks. Hey, I think it's important stuff that everybody goes through. But chapter 4, I don't know if you call it chapter, section 4, bonds foundation. You can go through all this bond stuff there if you want to go through it. Also, there's other information on here. And let me go to, say, Insights in Education. We get articles. And one thing you're going to hear a lot about are like yields. Okay, let's look at this article here. I'm not going to read the article, but let's look at the headline. Yields up on retail sales data. Let's think about what we know about bonds here as we discover this. Yields have gone up. Why would yields have gone up if retail sales came out strong? And the gist is the retail sales report was strong. Well, if retail sales are strong, that's showing a fairly robust economy right now. And so it seems that the Fed is less likely to try and push the interest rates down. But if the yields are up, then what's the price of bonds? Price of bonds are going down. There's less buying pressure on those bonds right now because, hey, there's more strength in the economy there. All right. So let me go out of this and let me come back here. All right. Now, you have choices here. Let me go to research. I'm going to go back to the page I was on, bonds, CDs, and fixed income. And I'm going to scroll down on this page. We've already seen this page a little bit, but let me just point out this. There's a section for bond funds and exchange traded funds here. If it is too daunting for you to try and pick out individual bonds, you may consider looking at other alternatives there for you. Now, I'm not going to get into bond ETFs today, but just realize we have a course, or not, we have a class where we talk about ETFs. Okay, that class occurs on Mondays, 4 o'clock Eastern Time. It's called Trading ETFs. And that is a possibility for some of you who don't want to try and pick out individual bonds. But just realize you have those same, that's all I'm going to talk about ETFs today. All right? Just make sure you educate yourself on that and before you actually do any trading there on that. But think of stocks, and their relationship to funds. Um, uh, say a mutual fund buys a lot of stocks, doesn't it? And then you invest in the mutual fund. Similar thing with bonds there. Okay, now maybe bonds are daunting to you, but you still want to invest in them. We have a section, same page, I just scrolled down to the bottom of the page. Call a fixed income specialist. 877-566-4021. Okay, there's your phone number. You can chat with somebody and talk about it if you like. Let's talk about there's other educational stuff on bonds here. If I go to learn, and if I go to, let me go back to, well, let's just go learn. If I click on bonds here, I can pull that up, and there's different articles on bonds. There's videos on bonds, and that's an old webcast I did. But there's a podcast where they talk about fixed income. Kathy Jones is Schwab's fixed income kind of guru person, and she's very knowledgeable, and I'd encourage you to read about that. Okay, and listen about bonds there. Now let's say we want to buy a bond. How do we do that? Well, this is what we do. Again, we can go up to research bonds there if we want, or we can go to trade. And under trade, you can click on bonds. Now, one of the things that's going to give you a choice on, and here's a page that when it comes to it, there's just, you need to read through. It's an agreement on this. Before you trade, it makes you sign some consent forms. I'm going to sign those real quick. Make sure you read those though. And you can see bonds, and this looks pretty similar to the other page we had, and you can see these. And if I wanted to buy one of these, let's say I wanted a AAA corporate bond out, we'll say 5 years, AAA corporate, make sure I got the right line, I'm going to click on it, and what it's going to do is it's going to give me choices here. Now it's just giving me one choice, Johnson & Johnson, and look at that. So this has a 6.95% coupon. That's a pretty high interest rate right now. That coupon is the interest rate. Okay, it's giving you the interest rate on that essentially. But what happens is, if that's issued at a higher rate, okay, 6.95 is a higher rate right now, and we're looking to buy it now, we've got to pay more for that bond than we would have paid at issuance. Notice the price. This price, $113. Well, bonds come up with the par value on a bond when you're starting out is going to be 100. So if we're paying 113, it's more expensive there because that coupon rate is higher. So what did I say earlier about that? Well, let me actually go on with one other thing here. If I go and I find something with a coupon rate that has, let's say the coupon rate is 2% for the same term bond, that price would likely be less than 100 in that case. Okay, so remember, 100 is going to be basically your starting value on those bonds. Effectively, on this bond, with that 6.95% coupon and a price of 113, your yield to maturity is just a little under 4. So it kind of evens out. In this case, what happened is this price started at 100, and I don't know what the original, well, the price started at 100. The original coupon was 6.95. Interest rates have gone down from that point. And when interest rates go down, what does the price do? The price goes up. Hence, our price is higher at that point. Okay? I'm hoping that has made sense to you folks. So you can buy individual bonds here. Let me go back. Individual corporate bonds or individual treasuries. By the way, U.S. Treasury zeros are what are called a zero coupon bond. In other words, they don't pay the interest payment every 6 months like other semi-annually like most bonds do. Okay. But what happens is you buy it at discount, and at the very end, you get paid more than what you originally bought it for. Okay. Let me just double check questions here and look, and Kevin's helping me out on that. Thank you very much. Yes, ETF classes Monday if you want to know more about that. And all right. So I can't talk about ETFs here, folks. So I'm going to have to punt on that question there on that. So let me go back and show you something else on this. Let me go back. And if I want to research and I want to go to bonds, what I can do is I can go to here and I can find bonds and fixed income if I want. I can also build the treasury ladder, which we're going to talk here in just a little bit. But if I click on find bonds here, it's going to give me this find bonds, and I can search for a particular bond by particular attributes. So for example, let's say I want to do a treasury bond. I can go to bond type. I'm going to change that to treasuries. Okay. There's my treasuries. And I'm just going to leave it at that right now. I'm going to say I want this out, we'll say at least a couple years. So I'll change that to a couple years out. And let me go out to maybe 5 years. We'll say October in 5 years. Okay. And I'm not going to be real specific on these, but you can always type this in. And I can say, well, I'll say I want my minimum coupon to be at least 5%. Okay, so I'm going to put in 5%. And I'm going to leave it at that right now. And I'm going to view my search results. When I pull it up, it's going to give me treasury bonds, at least 5%. Here's my maturity date on that. That's a minimum, that's my quantity. There's my price. Now remember, the price starts out at 100, and because I have a fairly high coupon level, 6.5% down the road there, my price is going to be above 100 right now there. And because I'm buying at a higher price, my actual yield to maturity is not going to be 6.5%, right? If I bought right at 100, then my yield to maturity would probably be about 6.5% there. Now, let's say you buy a bond, okay, and this is going to Sim in the chat said, sometimes your bonds lose value because the interest rate's being risen. Yeah, if you buy a bond, if you, in terms of your decision of whether you want to buy a bond, let's say we buy a bond right now, okay, and interest rates across the board go up. Interest rates go up. How are you feeling about that bond purchase? If you bought a bond right now, we'll say at 4%, and anybody else can go out, you can go out in another year and buy one at 6%, your bond is less attractive, isn't it? And so the price of your bond is going to go down. And that is not that's obviously not what you want to have happen. Therefore, if you expect a rising interest rate environment, a lot of traders are less likely to buy bonds. If you expect a generally lowering or declining interest rate environment, bonds may be more attractive to buy right now when you can lock in that higher price. Okay? Now, there's another thing with bonds that we can do, and that is called a bond ladder. So let me go to this Treasury Ladder Builder. And let's talk about bond ladders for a sec. So what a bond ladder is this. Because of the interest rate concern that people have of interest rates changing after you get in, is sometimes people want to buy bonds on a fairly regimented, a regular schedule, so that this interest rate risk can potentially be minimized. In other words, let's say we buy a bond right now and interest rates go up. What's going to happen to our bond price? Well, bond prices are going to go down. Well, I can then buy again in another year or 6 months or whatever interval you want, and buy at the newer interest rate time period. Okay. So let's talk about this bond ladder. Let's say we do a 5-year ladder. So I'm going to say we're going to do a 5-year ladder. 1, 2, 3, 4, 5. 5 years. Okay. And we're on year 0 right now. Okay. And so we're going to buy a bond that matures in 1 year. And so we buy that bond now, and we buy a 2-year bond now, and we buy one that expires in 3 years now, and we buy a bond that expires in 4 years now, and one that expires in 5 years now. Okay. What happens after a year? Well, after a year, this one has matured. This bond has matured. So this bond is going away. At that point, though, what we would do is we'd go on and we'd buy one that expires in 5 years from this point in time. And then in another year, this one is going to mature. And what are we going to do at that point? We're going to buy one that expires in 5 years. Okay. So that's what's called a bond ladder. That's an example of a bond ladder. You can do this with treasuries. You can do this with governmental bonds. You can do this with corporate bonds as well, if you like. So that's a treasury ladder. Now, what happens in between these years? Interest rates are going to go up or down along the way. But this way, you're taking advantage of that, and it's kind of like diversifying. If we can make it liken this to buying stocks, typically you're not going to put all your money in one stock because, yeah, it may work out well for you, but it could also work out really poorly if you're not diversified on that. So therefore, what you do is, this is kind of a way of diversifying your bond portfolio to not only interest rate risk, but assuming these aren't all the same corporation or something that you're buying them from, to default risk. In case one of them defaults or something, at least you have your money in other bonds there. All right. So that's what a bond ladder would look like. Let's show you can do that on here. When you click on CD and Treasury Ladder, and just to remind you, there's actually a couple different places you can get to on this. One, if you click on Trade Bonds, and let's see. Oh, I was thinking you can do it on that page. In any case, go to Bonds, CDs, Fixed Income, and there's this CD and Treasury Ladder. Okay. So let me click right on here. And we have some predefined ladders to help you out, but you can create your own. You can just create your custom ladder. Let's do a 5-rung ladder though, okay? And so I'm going to select that. Just, it highlights it. And now I made a mistake. That's a CD ladder. See, a certificate deposit ladder. You can do that as well, but I'm actually going to do a treasury ladder here. I'm going to do a 5-year ladder, and it kind of predefined, and it gives you interest rates. And notice our yield curve is fairly flat, so we're right around that 4%. And let me go to, let's say our initial investment is going to be $20,000. Okay, so I'm going to put in 20,000 there, and I'm going to continue to choose investments. Oh, choose an account. Okay, it's going to make me choose an account. Continue to choose investments. So now I'm going to have a 5-year treasury ladder. Now, look, down here, it gives me rung 1. This is going to be the first year. So when are these going to expire or mature? These are going to mature in about a year. Okay, well, here's about 1-year maturities. Okay, 1-year maturities. Here's rung 2. So I'm going to click on 1, and you can see your coupon rate and whatnot on that. So I'm just going to check it. And so that's rung 1. Now you can see interest payment here, and bonds typical are going to be pay interest semi-annually, okay, twice a year. And here's the principal. So you buy the bond, you get paid the interest payment on the way, and then you get paid your initial payment back. Okay. Let's go to rung 2. I'm going to go to rung 2, click on 1. Rung 3, I'm going to click on 1. Rung 4, we'll click on 1. And rung 5, and there's only 1 available there on that. But here we go. So as we're looking at this, here is an interest payment. Here's a principal. Here's principal coming back. Notice there's some interest because those bonds, the ones that aren't maturing, pay a little bit of interest at this point. It's kind of hard to tell that color difference there, but there's a little bit of interest that's getting paid along the way. And then presumably at this point, at this point, at this point, you may consider buying a new bond along the way. And so that is a bond ladder there. So let me continue to review that ladder. Here we go. So my initial principal cost, my par value is $20,000. So we're paying a little bit more. We're paying a little bit more. Now let's talk about what's accrued interest. Well, these are not original issue. We're not buying these from the Treasury. We're buying these. These are secondary market bonds here. And so what happens is if you buy them between dates where you're getting your coupon, between interest payment dates, the holder of the bond maybe has held that bond for a little while, but hasn't got any interest because that interest payment date hasn't occurred yet. That coupon date hasn't occurred yet. And therefore, you have to pay a little bit extra for that. That's what accrued interest is there. That you got to pay for that. Because if you're buying this, you're getting the benefit of not holding it the full 6 months before the next coupon payment. And so that's where that accrued interest comes in. Your average coupon, 4.5%. Okay, average maturity, about 3 years. Of course, that makes sense because we have a 5-year rung, 5-year ladder on that. Average price, a little bit more than the $100 that we're starting with. And your annual cash flow is right around $900 there. And then if you want to trade, you can choose to trade that right there. So that's a treasury bond ladder here. Now, if you want to find bonds, one way to do it is, I already showed you how to search for them, but if you know the bond's CUSIP number, you can just type in that CUSIP number right in there. So, for example, and by the way, little tangent before I talk about CUSIP numbers. Someone was asking earlier about bond ETFs. Again, watch the class. There is a screener, though. You can go there and look for bond ETFs right there. It's a little bit hidden, but you can check that out. I can't go there right now on that. Let me go to trade bonds again here. I'm going to go to trade. I'm going to go to bonds. I'm going to go to corporate bonds. Let's go to AA. We'll go out a couple years, pull this up. Here's a Walmart. And so here's this bond. Now I can click on this if I want. And I want to talk about some of the terminology here on this. So here's the CUSIP number. Remember, if you write this down and want to pull back in the future, you just remember, write down that CUSIP number so you can pull it up that way. And it tells you about the bond a little bit and some of the stuff that we've talked about already. One thing I should mention is one term associated with bonds that you need to be familiar with is callable bonds. What does that mean? A lot of you have heard of are maybe involved with options or something where we talk about call options. Totally different, okay? Totally different. A callable bond is one where the issuer of the bond can just pay you back your principal and accrued interest at that point in time, if you want, and then you no longer have the bond. Now, why would they do that? Well, think about it this way. Let's say they issue a bond at, say, a 5% interest rate, but interest rates go down across the board. If they can buy back your bond and pay you what they owe you for that point, but issue a different bond, we'll say it goes down to interest rates of 3%, they can issue a different bond to a different person, only paying 3% interest rate, then totally, it certainly benefits them financially. So that's a callable bond. Some bonds are going to be non-callable, okay? And if your bond is not callable, then let's say you get that bond and interest rates go down. That company is stuck paying you that higher rate and can't get out of it early. And so a non-callable bond, everything else being equal, would tend to be a little bit more expensive than a callable bond because you can't get out at any time there, okay? So, and there's stipulations on the call schedule here, 10 days notice at a certain time when it can be, so you just got to read that there on that. So that's how you can look through those bonds. As I mentioned, semi-annual is your typical interest payment on there. If you are interested in learning more about bonds, in addition to what we've talked about, in addition to the education I talked about, there's a glossary. You can click on that glossary and pull up terms that you may be interested in. Now, another thing I'd point out, bonds are rated. This was a AA S&P rating. There are two principal ratings agencies, S&P ratings, Moody's. This one doesn't have a Moody's rating, but this one is a AA. And their nomenclature, their terminology is a little different for each one, but just realize they could rate something a AAA and it could go default. They could default. Okay, so it's not a guarantee, but this is a measure that people use to try and judge the creditworthiness to the bond. So just be aware of that. It's important to know that, and you can look at those credit agencies, or those rating agencies as well there. And finally, you do your research on bonds just like any other, a stock. If I'm going to invest in a stock and I want that stock price to go up, I want to be confident that the stock is going to go up. If I want to invest in a bond, I'm going to be confident that bond, they're not going to default or anything. I want to research that company there as well. All right, everybody. So there you go. That's bonds. That's an introduction to bonds. Obviously, there's a lot more. I showed you where those resources were for bonds. Kevin, thank you for helping me out in the chat. and appreciate you joining me. And what we will do is we will see you all same time next week. Everybody have a wonderful rest of the day. Make sure you follow us on Trader Talks, on the YouTube channel, and on X. Kevin put those X handles in the chat, at Brent Moore CS, at Kevin Horner CS. Have a wonderful rest of the day, everybody. Bye-bye.